This is my 10-slide review of accounting. It's going to cover the basics for our financial management course. So when we talk about accounting, we're really going to look at the financial reports, the three primary ones, and the 9 concepts that back up financial accounting. We'll look momentarily at depreciation, and we'll talk about the cash flow statement. We end this with key ratios, which is really the beginning of chapter 3. So when we look at financial reports, we have a balance sheet that tells us at any point in time what the balance of our assets, liabilities, and equity are going to become. And so we have the formula that says that our assets are equal to the liabilities plus owner equity. Or another way of thinking of this, the assets are funded either by borrowing, that's liabilities, or by owner's equity, that's money that's put up by the owners of the company. So all assets are paid for one of 2 ways, and that's the 2 ways. Balance sheets are point in time, so they tell you as of right now where a company is. They don't cover periods of time. So you could pull a balance sheet in a retail company every 5 minutes and get a different answer because you have sales going on continuously. Income statements. Income statements are basically describing what happens between 2 points in time. They're focused on revenue, and revenue means that I've sold something, and they're focused on the expenses that are associated with earning that revenue. So we have the equation, revenue minus expenses tells us something about our net profit. And of course, if we have net profit from a period in time, that net profit adds to owner's equity in something called retained earnings. If we have a loss, it takes away from owner's equity in the same way. All income statements are for a period of time, so you might see a monthly, a quarterly, or an annual income statement. Cash flow. Because we are concerned in our income statement with all expenses, we may have some expenses that have not been paid yet, and so we might have accounts payable. We might have money that's coming to us, and that's an accounts receivable. If I was on a purely cash basis, I wouldn't count my receivables and my payables. I would just look at cash. Cash is very important to every company because essentially that's what allows you to pay the bills when they come due and allows you to manage the amount of assets that can be acquired or paid for through cash in any period of time. You can't overspend or write a rubber check, basically, if you're running a good company. So we pay a lot of attention to cash flow. And it only shows the changes that affect cash. So a sale that is on credit would not show up in a cash flow. A order of merchandise that I put in the store but haven't paid the bill would again not show up in cash flow until I actually pay the bill. Basically, this is tied to the solvency of the company and the ability to pay bills, so we pay a lot of attention to cash flow. Finally, there's a statement of retained earnings. So once I have earnings, then I would pay attention to what do I do with them. Did I pay a dividend or not? If no dividend is paid, then retained earnings from a prior period plus new retained earnings would equal my posted retained earnings. If I pay out a dividend, that might be part of the earnings that I'm giving back to the owners. Financial reports. Let's talk balance sheets first. They have assets on them, and one side of our balance sheet is going to talk about assets. We think of them in terms of assets that are short-term, which we call current, and long-term, non-current, which are fixed assets. So our current assets are things like cash, receivables, so somebody owes us money. Our inventory is a current asset. because I can sell it and turn it into cash pretty quickly. And prepaid items like insurance policies. Non-current assets include things like equipment and buildings and land, and this weird one called goodwill. If I buy another company and pay a certain amount for that company, the excess that I pay it over whatever the balance of their balance sheet is going to be called goodwill. So if a company's balance sheet says they have $1 million in assets and I give them $1,200,000, then goodwill would be posted at $200,000. So that's listed as non-current, and we depreciate or write that off over time, just as we do buildings and equipment. We never depreciate land. So all of our assets are paid for one or two ways. One is through our liabilities, the borrowing, and you have current liabilities. Those are things that are like accounts payable. Anything that's payable, including payments on notes or long-term debt, may show up here. But all things that are called payables, where you owe money, are considered to be current liabilities. Non-current liabilities are those things that are greater than a year. So notes and bonds. A note might be a mortgage in a house. A bond might be me selling bonds to raise money out in the capital markets. The other way that things are paid for is by the owners putting up money. Sometimes they do paid-in capital. That means the owners actually put up their own money to start the company. And they can also turn around and sell stock. So they can raise money by selling stock to people. Now, typically that's done through an IPO if you go public, but stock sold in the stock market is not the same as the stock discussed here. Stock on the stock market is sold between two different owners in the company, so they're trading ownership. This is where we're actually raising money by selling stock in the first place. And finally, we could have retained earnings for prior periods. So if last year I made $1 million in net profit, that would be retained earnings starting out this year, and then I could have additional retained earnings as the year goes on. And again, this can be a loss. That's one of the exceptions. Generally, all of these accounts will have a positive balance. Now, some people talk about credits and debits. You may say that a credit is good and a debit is bad, but the reality is everything on the asset side of the column has a balance that would be a debit balance. So the cash is a debit balance. Receivables have a debit balance. That means if I have cash or if I have receivables, the balance is considered to be in the debit account. Liabilities are all in the credit account. So everything I owe is a credit, be it notes, bonds, or anything like that. Also in the credit account is retained earnings and paid-in capital from. So all of our equity accounts are on the credit side. So that's important to understand that credits and debits refer to the positive or negative that's associated with a particular account, not the name of the account. So let's look at income statements a minute. Income statements have revenue. Revenue is made up of sales, interest that we might get if we have investments or bonds or something like that. Someone gives us money, we get a settlement or something. There are other reasons you might have revenue. But those revenues essentially are associated with that period of time. And during that period of time we can have expenses. We look at all kind of expenses, but the number one expense we look at is cost of goods sold. If I'm selling something. If I'm not selling something, a service, I wouldn't have this. But a cost of goods sold is telling me how much did the items that I sell cost. Once I've subtracted that out, I have a gross profit. Then we consider the expenses that come in, things like payroll, travel, utilities. You just go on and on. There's lots of different kind of expenses. Interest expense, if I have to pay interest on a mortgage, tax expense, depreciation. The depreciation's an interesting one because depreciation's not actually cash going out of our pocket, but it's us taking a piece of the equipment as long-term assets and writing them off over time, so that we can associate the use of those assets with a period of time and come up with an expense to allocate. Really, depreciation gives us a tax deduction is what it does. And we'll see that a little bit later. But once I have my revenue and I take into account all the expenses in the same time period, I create the net income after taxes. So taxes is certainly one of those items. And I can give away dividends. Something about dividends to understand is that sometimes we have stock that is called preferred stock. Preferred stock we pay the dividends on before we look at the net profit available for common stockholders. Most companies don't have preferred stock, but in case they do, that's how it's related. So then I have the retained earnings. Those dividends paid would go to the common stockholders. We can figure out what our earnings per share would be. We can also figure out what our dividends per share would be, and they call that in the stock market the yield. So let's talk debits and credits a minute. Our assets are on the debit side, and so are our expenses. On the credit side, we have the liabilities and the owner's equity. So this is the way we need to understand it. We have one more item that's on the credit side, which is going to be our revenue. So I have a revenue minus expenses equals retained earnings, and retained earnings sits under the owner's equity, so that's why it has a credit balance. So assets like cash have a debit balance, and our expenses also have a debit balance, always. And the credit balances go with the other three. So there are 9 basic precepts to accounting. We're going to look at the basic precepts behind accounting. There's 9 of them that are the key ones. One is the dual aspect. Basically, we have 2 entries every time we make an entry, a debit and a credit. And at all times, the assets must equal liabilities plus owner equity. The second one is the realization. Realization concept, when we look at revenue, it's when the goods are delivered. So if I buy something like a book and have it delivered in the month of February, and I'm in the month of January, I don't count that as revenue for that month. I count it in the and measure it as when goods are delivered. In some cases, they write the contracts so that it's FOB origin versus FOB freight on delivery, FOB destination, and that essentially origin means that when it reaches my loading dock, I consider it delivered. So some people that ship like Amazon out of their shipping address oftentimes will do it FOB origin, meaning that they consider delivered as soon as it leaves their warehouse, regardless of when it gets received. So realization ties to revenue, and of course we want to match expenses to that same time period. So we always look at when the goods are delivered as to the assignment of the period. Materiality. That's what I like to say is we don't count paper clips. We disregard significant matters. So I may buy a box of paper clips that's going to last me for 2 years, but I expense it right now because I don't want to count small things like that. Big things like computers, I might want to expense a computer even though it's going to last multiple years. But if I have to buy 100 computers, that's a lot of money, so I probably need to take those up as a capital asset and write them off over several years. Conservatism. Conservatism is the idea that I recognize revenue when it's certain. So when I deliver the goods, that's when I consider it. Expenses when they're likely. So if I think an expense is going to happen and believe it's going to happen, I put the expense into the time period. So what that does is it gives me a conservative estimate of profits rather than an optimistic estimate of profits. Money measurement. Money, everything's measured in money. So even though in accounting we keep track of all these things in money, the reality is in accounting we also need to track more than just money. We need data on units and things, quantities and things like that that aren't just money facts, but the actual accounting is on money only. So a non-material like things that don't have money associated with it oftentimes are not listed in a balance sheet or an income statement, and consequently the fact that I have a contract or someone's working for the company and he's a superstar may not show up on a balance sheet, but certainly people are aware that if certain individuals leave an organization, it's going to have an impact on the company. But accounting only is looking at money items. Entity. This entity is separate from people, so cash doesn't mean cash is in your pocket. Cash means cash that belongs to the company. So it's almost like a separate person. So when we create a legal entity, be it a LLC or corporation, S Corp or C Corp, those are entities. They have legal rights. They have limitations of liability in terms of how much people could sue the people running the companies for. They can go bankrupt, but those have to be completely separated from the personal side of things. So if I own stock and the stock goes down, I might say that I lost some money, but the entity didn't lose any money. So when the stock price varies, the companies are not losing or gaining money. When we look at those changes that happen all the time on Wall Street. Going concern. Our essential assumption in accounting is that we're not going out of business, because the company behaves differently when going out of business. So as long as we have continuity of operations, accounting makes sense. Asset measurement. If I have an asset, I have to equate it to the dollar at which I acquired it. So because it's only in asset amounts, if I acquire a truck and I got a particularly good deal on it, say it was a $20,000 truck and I got $5,000 off, I only post that truck at the amount I actually paid, not what I might say it's worth. That's a key important area, because quite often balance sheets understate the value of assets. Like if I bought a piece of property 30 years ago and have a building on it, I might still have it on the books at the price that I bought the property for, not the value of the current value of the property. And part of that goes back to the going concern, where our assumption is we're not selling that asset as part of the business to make profit. So consequently, because we're not selling it, we don't revalue those assets. And the last one is the matching concept, the idea that revenue and expenses match in the same time period. Okay, a couple words about depreciation. When we have a capital asset or a fixed asset, they have different names for them. One of the problems is we don't typically expense those things in the period in which we acquire them. And consequently, we need to write off a little piece of those assets over time. The way we keep track of that is we have an account where we record the amount of the asset. So I have a truck here for $50,000, and each time period, if I was depreciating in 5 years on a straight line basis, I would take $10,000 a year. So that would represent 1 year. Accumulated depreciation is not actually a negative number, but it's understood that it subtracts from the value that we paid for the item in the first place. This is going to become very important in Chapter 12 when we're doing capital asset planning, because we need to figure out what the actual depreciation and book value are. The book value then is the net value between what we paid for an item and how much depreciation's occurred. Expenses. When we take and lower the book value or add to the accumulated depreciation, we take a depreciation expense. So the debit is the expense and the credit is the accumulated depreciation. Remember, assets have a debit balance, so when I put a credit into an asset account, that takes it the opposite direction. So accumulated depreciation subtracts from the value of what we paid for something. And so graphically this kind of looks like this. I paid $50,000 for the truck, and the second year it's worth $40,000, the third year it's worth 30, 20 until the truck is gone. And when we study depreciation a little more in depth, we're going to understand that what it's really doing is that's giving us not money leaving our pocket, but that's giving us a tax deduction in that year, and so it's sheltering income. So it gives us a tax deduction where we don't pay income tax on that piece that we call depreciation. There's different kinds of depreciation, and again we'll look at those in more depth. Assets are recorded at cost. You can have straight line depreciation, but very few of them do, because the government allows us to do what they call accelerated depreciation, and the MACRS tables define what that happens to be. Accelerated essentially means I'm taking more depreciation in the early years, less in the later years, because partly it's assumed that in the early years you don't have all the maintenance that goes with maintaining that asset. In later years you have an expense for the maintenance. Because land doesn't go away, it is rarely depreciated. There might be a case when we looked at that, but the part of land that could be depreciated or written off is mineral rights, for instance, could be depleted. So really, depreciation expense is an estimate. So we use a table that calculates how much to take off. That gives us a tax sheltering for some dollars, and we usually take advantage of the government's accelerated rates. Our book value then is the cost that we paid for it minus the accumulated depreciation. And again, just remember that on every balance sheet, the book value of something is not what it's really worth. The book value is simply the cost minus the accumulated depreciation. Our next topic is on the cash flows. Cash flow is only things that affect cash. So the fact that I have depreciation doesn't affect cash. It affects cash when I bought the item and when I paid for it. So cash is kind of like your bank book. When you think about money coming in and going out of your bank, all they account for is cash. So you have a beginning balance, and if we have sales, we deposit the money in the bank, and that shows up as cash. If I get money in from accounts receivables, that shows up as cash. Even though it might have been sales that happened 3 months ago, if I'm receiving money this month, then it's cash in a cash flow sense in the month that you receive the cash. When I pay money out for buying new assets, or if I pay money out for payroll, if I pay money out for rent, anytime I pay money out, then that's considered to be negative to the cash flow. Remember, cash has a debit balance, so this little T is referring to a T account. The left side is debit and the right side is credits to the cash account. So pretty much everything that happens in the cash account is just like your checkbook, and the fact that you've written a check isn't as important as to the bank is when they actually pay for that check. But to you, you treat cash as if when you write a check, as if you have lowered the amount of cash that you have. If I sell bonds, I get cash. If I pay off accounts payable, so I bought inventory that I received 2 months ago and I pay it today, that's cash. And at the end of the month, I have an ending balance, which is basically the the net of the two. And of course, my ending balance is the beginning balance for the next period. Net cash flow. Well, I started at $130,000. I ended up with 101. That's minus $29,000. I couldn't have too many months when I went a minus 29,000 before I'd run out of cash. So again, cash management is one of the chapters we're going to talk about. But it's very important that we manage the cash of a company. Final topic here in this little video is key ratios and metrics. The key ratios and metrics are things that we look at to measure how we're doing. And Chapter 3 is going to get into that as we get into financial analysis. I'll just briefly talk about them here because, again, these are not actual accounting things, but they're relations between accounting data. So, for instance, profitability, or the profit margin, is how much money did I make divided by the sales in percent. And some people call it the net profit margin. And a lot of times we put things in terms of percent of sales. So that's one of the key ones we'll look at in that chapter. The gross margin. So I have the amount of money that I took in for revenue, that's my sales, and what did I pay for the items. So I have to take off the cost of whatever I paid for the items to know my gross margin, and that's the percentage of sales. So in a retail company, that might be 50 or 60% is the gross margin percentage. Then I have a lot of other expenses to subtract from there. A little bit about capital utilization. So, and then person puts money into the company, and we call it equity. So an owner has equity in the company, so we're interested in how much they make on the money they have invested. Another thing we look at is days receivable. That's a calculation that says if I have $200,000 in receivables and $2 million worth in sales, I can calculate basically how many days it's taking me to receive the money that is being paid to me under the accounts receivable. This is an important number because if it starts to go up, and for instance I give everybody 30 days and they're taking 31, 32, 33 days, and it starts to go up, then essentially I'm not getting cash in, which is affecting my cash flow, and people aren't paying the bills. If it starts getting too high, you know, I want to pay attention to my receivables. I'm going to worry about inventory turnover. A retailer typically turns their inventory 4 times per year. It's like a Macy's or Dillard's would be in that category. We're very interested in inventory turnover there because if it's not turning fast enough, then there's a problem. So if the winter clothes come in and they aren't gone within about 3 months, then I start being real concerned if they still have winter clothes at the 6-month mark. That's part of the reason why they're always running sales at a Macy's is the items come in and they're full price. After a month they lower the price by a third. After a month they lower another third, and after another month they're practically paying you to take it away. Well, it's maybe 10% or 20% of the initial value. So they're very interested in how long they hold that inventory in their store. The faster they turn it, the better. A retailer like a Walmart or someone that is turning like a grocery store needs to turn their inventory very quickly. A grocery store might have a inventory turn of every 2 weeks. Well, every 2 weeks is 56 weeks in a year, so that means they would be selling their inventory 26 times in a year. And so, you know, you certainly wouldn't want to come in and find a 4-month-old container of milk, but certainly it goes by category of merchandise. So canned goods can sit on the shelf longer than the highly perishable items. We run a company, we look about this thing called a current ratio. Current ratio says I have so many current assets, things like things like cash rather, where I have current ratio. Things like the current assets are like cash, that I use to pay my bills, the accounts payable. If I don't have enough cash to pay my current bills, I'm in trouble. Though we do count inventory and current, but you can't imagine we could sell all that inventory just to pay our current bills. So they have a separate ratio called quick ratio, which looks at basically my cash and things that I can quickly turn into cash, not inventory, to pay those current liabilities. We look at how much debt ratio is. Remember, I said all assets are paid for by either liabilities or owner's equity, and the debt ratio just says how much of the assets are funded with borrowing. So if 50% of my assets are paid for by loans, the debt ratio would be 0.5 or 50%. A bank not going to loan you money if your debt ratio is 90%, because they're going to say 90% of your assets are funded by somebody already loaning you money, so I don't want to loan you more. Managing the amount of debt that a company has is very important. Return on equity, that says the owners have got so much equity in the company, what is the return? Usually stated as a percentage. And finally, things like metrics. How much working capital do I have? So I need a certain amount of working capital as the cash or the excess of capital that you have above the current liabilities. It's what you have to work with to pay bills and to manage the company. Permanent capital is what you need overall, which is the value of all your non-current assets. That's your fixed assets, land and buildings and those kind of things, plus the working capital. So again, these are things we're going to look at in Chapter 3.